If there's one piece of advice that's so relevant today, it's to not let the present lull fool you. According to our next guest, Alasdair Macleod, we're risking a 1929 style crash and depression. And Macleod knows a thing or two about the markets. As a world renowned stockbroker and member of the London Stock Exchange for over 4 decades, Macleod has essentially seen it all. But there's one thing that perplexes him: mainstream economists and so-called financial experts who consistently support Keynesian monetary policies. As he puts it in this thought-provoking interview, Macleod warns that we're near the end of the expansionary phase of the credit cycle. Thus, we could see incredibly damaging events unfold, which is exactly why you need to check out crushthestreet.com/goldbook. In it, Macleod offers his exclusive insights into the real story behind this economic and geopolitical circus. Once again, that's crushthestreet.com/goldbook. So without further ado, here's Alasdair Macleod.
Hello, everyone, and welcome into crushthestreet.com. I'm joined today with a very special guest, Alasdair Macleod, a senior fellow with goldmoney.com, someone who puts out regular content on the markets, what's going on with metals, and really things that other news sources, mainstream news sources, are not covering, maybe because they don't want to, there's an agenda, or maybe because they just don't understand it. And I appreciate guys like Alasdair who really understand true, sound, fundamental economics. And you know what? The understanding the theory of economics. What is best for incentivizing productive behavior? Because when you get too far along the rabbit hole of manipulating what would be productive behavior, you have to artificially sustain that boat. And I think we've seen that all around the world. And we're all wondering how long all this artificial behavior can be sustained by all this manipulation. And I think we're going to discuss that today. Alasdair, thanks for coming on the show with me today and taking some time with us.
That's very much my pleasure, Kenneth.
Alasdair, let's start off with the markets right now. I know, here in the U.S., stocks have been hitting, all-time highs. We do have volatility as of lately. We saw interest rates start to become a problem towards the end of 2018. And here we are once again. It just keeps teeter-tottering. But if we were to base our experiences off of what we've seen for the last 10 years, it's just another bump in the road, and stocks are going to go to new all-time highs. That's at least what we can expect based on past experiences. But I'd like to get your thoughts on this.
Well, that's wishful thinking, in my view. We need to just take a step back. The important thing to understand is that we are at the very end of the expansionary phase of the credit cycle. And the other thing we have to understand is that at the same time as the expansionary phase is coming to an end, we have trade protectionism, we have tariffs, and all the rest of it. Now, the last time this happened was in 1929. In October 1929, Congress passed the Smoot-Hawley Tariff Act. It was actually signed into law by President Hoover in, I think it was about May 1930. But that month, it was clear to the market that Congress was going to sign Smoot-Hawley into law, and that was the month when the Dow Jones fell top to bottom 35%. That was the extent of the swing in that month. And there was a recovery after that, which sort of went more or less until President Hoover then signed it into law. So the whole thing became live. And we know what happened from there. The stock market just went down and down and down and down. And at the worst, it lost just under 90% from its all-time highs. Now, we have exactly the same situation happening today. The amounts are different. The Smoot-Hawley tariffs were actually horrendous. Trump's tariffs are bad enough, but they were not anything like Smoot-Hawley. But on the other hand, the expansion of credit this time has been absolutely without precedent. And so we do, between those two events, have the potential, I think, for a repeat of the circumstances that led into the 1930s depression. Now, having said that, there is one fundamental difference as far as the markets are concerned, and that is that in 1930 to 1933, you had gold at $20.67 to the ounce. So prices were actually in gold through the dollar. I think from about January 1934, Roosevelt then he devalued the dollar, and that went to $35, which held all the way through to sort of into the 1960s. But the point is that the prices were in gold. This time we've got complete fiat money. So the behavior of markets and of prices is likely to be different to reflect that distinction.
So, Alasdair, is it possible that, or just create some context or give us some context for the Smoot-Hawley tariffs? Was that the straw that broke the camel's back for the Depression, among many other things, or was it a very material component to what threw the economy into the Depression?
I think the answer to this, Kenneth, is that nobody's really done the research on it. I mean, I thought about this quite deeply, and I think what we saw was a combination of the two factors. I mean, for a start, very few people understand the credit cycle. And certainly Keynesian economists have got no conception of the credit cycle at all. And amongst the Keynesian economists, I would say that anyone who claims to be a macroeconomist basically is a Keynesian. And so investment managers don't understand it either. We have this credit cycle, and the last time it went under, of course, was the great financial crisis 10, 11 years ago. And the time before that was after the dot-com bubble, and so on and so forth. This is a periodic event, and it is getting worse and worse every time the cycle has another turn. On top of that, you have the tariffs. Now, you've already seen in the statistics how the tariffs have collapsed global trade, if you like, trade between different nations. You have seen how Germany has been so badly affected because China is one of her major markets for her auto industry. And so that's basically gone now. You have, it's a combination of these two factors which actually, I think if you work it through, are potentially extremely dangerous. There's a sort of, there's a word going back from the 70s that they used in the stock market in a rather different context, synergy. There's a synergistic effect between the two, which we must not underestimate.
Well, that's a powerful thing. It's really not something I hear people talking about a whole lot, is that specific tariff, the Great Depression, and what we're experiencing now. I know a lot of people are frustrated with the tariffs. Now, is it a financial chess move? A global geopolitical financial chess move Trump is playing? And is it something you think he wants or maybe understands more deeply than we might otherwise give him credit for? And, hoping to get some concessions and negotiate some things and hopefully back off of certain trade tariffs and taxes that are obviously not good for everyone as a whole.
Deep economic analysis and President Trump don't sit happily in the same sentence, I'm afraid. I think that he actually hasn't got a clue what he's doing. He doesn't understand how a trade deficit arises. The trade deficit arises basically due to two factors. Firstly, savers don't save. And secondly, the government runs a budget deficit. And that means that the budget deficit is effectively mirrored in a trade deficit. So it is his government that has created the trade deficit. So what does he do? He then introduces tariffs, which is an extra charge on goods bought by American consumers. So who's he hurting? He's actually hurting the average American.
Sure.
And of course, the response from China also, sort of hurts various parts of the American economy, particularly the agricultural sector. So, nobody wins from this rubbish. And he has got in the White House, he's got people who just don't understand this at all. I think the US Treasury understand it. They understand the twin deficit phenomenon, and they understand that this policy is no good. And I think, this is why we get this, one day it looks like we're going to get some sort of sensible negotiations in progress, and then the next day President Trump rubbishes it. I mean, you've got, I think he's fighting the Treasury on this one. He doesn't understand the damage he is creating. When it comes to the geopolitics, yes, there are geopolitical issues here, and America has definitely cast China as a number one enemy. Yes, China is seen by President Trump, and I think actually by his intelligence services, as the number one enemy. Their technology is advancing very, very rapidly. In certain areas, they're well ahead of America. And this is, I think, why the attack on Huawei is being prosecuted. On top of that, I think it's the sheer might of the Chinese economy that is worrying. And as far as the US Treasury is concerned, they need the global portfolio flows to continue to finance the US budget deficit. They need foreigners to continue to buy US Treasuries. Now, I think this brings Hong Kong into it, because Hong Kong is the channel for something called Shanghai Connect. Shanghai Connect is the means by which foreigners can invest in China. They can get their money out, and they can get it in, and they can get it out with absolutely no restrictions, no taxes, whatever. So foreigners can invest in China. China wants that portfolio money to help her develop her infrastructure and to build the communications across the entire Asian continent. America needs that money. So what does she do? She disrupts Hong Kong. Or at least that is the story that is coming from China itself. I don't know whether it's true. I suspect it is true, because that's the way these things are done. But if you think this one through, then that does actually explain why there is so much action against Hong Kong from America on the legislative side, for example. The Chinese are convinced that America is stoking up the whole riot scene. So this is not good, and I just don't see a good outcome from this at all. I don't see that China and America are going to sit down and resolve their differences. I think that's cloud cuckoo land. It's not going to happen. So this is worrying, and I think it means that the tendency towards trade protectionism is going to accelerate rather than decelerate. The Chinese are already taking the view that they can work without America. I think they have primed their population to be anti-American, which is not constructive, obviously. This is not good. And I think it's a situation where you've got these two enormous economies clashing against each other. And how are we going to come out of it? I don't think it's going to be a good story. I don't think it's going to have a good ending.
Right. Well, and it's definitely a sign of the times, right? You go back to 2016, 2015, whatnot. Donald Trump's election was a sign of, the frustration coming out of all of this manipulation and artificial changes that have been done to our economies. And one thing I did want to talk to you about and have you comment on is Brexit. I mean, that too was, again, another in the face of the conventional wisdom, mainstream media. This is something that the progressives were all in favor of, all the globalists, and the UK voted to Brexit. And so my question is for you, what are your thoughts on this? Is it positive? Is it a problem that the UK is not going to be in cooperation with the EU? What are your thoughts on this?
Well, I think as far as the UK is concerned, one should understand that the issue is not trade, but the issue is sovereignty. It is making our own laws. It is Parliament actually being superior to anything else in the land, not the EU. The EU is going in a direction of assembling its own army. It's going to want to integrate taxes. It's going to do all the sort of stuff which takes sovereignty away. And we've got to the point where this is becoming absolutely clear. The Brexit campaign was very cleverly run by someone called Dominic Cummings. And he used social media to get the numbers up. And the result is that, okay, they were voted for Brexit, and this was in, I think it was June, July 2016. We got that one through. We're now in a situation where the government has been trying to backtrack on it. This was under Mrs. May, and effectively only half leave. And it was a complete nonsense. Anyway, she got chucked out, and we now have Boris Johnson. And Boris was elected basically by his peers in the Conservative Party to prosecute Brexit, get it done. And that is what will happen. We will come out on the 31st of October. The damage to the UK is actually going to be pretty limited. I mean, all the preparations have been made. It's rather like the millennial bug, if you remember that. We thought that the whole world would fall apart because all the computers would shut down and all the rest of it. And of course, nothing happened. We've had the same sort of scare stories over Brexit. Really, as far as the UK economy is concerned, it's not going to be bad. I mean, there are going to be some losers. But those losers, I think, will very quickly refocus their efforts when it comes to exports into other directions. The general level of prices in the UK, assuming that we reduce tariffs, will tend to fall, which I think will be good for the economy. So one way and another, Brexit is okay for the UK. The problem lies actually in Europe. There was a German think tank which made an estimate on the job losses in Europe, and they came to the conclusion it would be around about 450,000 compared with their estimate for the UK of only 12,000. 100,000 of those were going to be in Germany, and at least 50,000 will be in France. Now, since that came out, the Irish Central Bank came out with an estimate on the Irish economy. And they reckon that in the Irish economy alone, they would lose 100,000 jobs. So you can see that the nervousness is building up on the EU side rather than in the UK side. We've still got, sort of Remainers who absolutely insist that it's the worst thing that's ever happened and, it's the end of the world and all the rest of it. We've still got, those people. But after October the 31st, it will be done. It will be gone. And interestingly, I mentioned Dominic Cummings. Your listeners might like to know that he is actually the chief special advisor to Boris Johnson in 10 Downing Street. So this sort of Svengali genius, if you like, at manipulating everything is going to, he's in there. And already we're seeing that in the opinion polls, the Conservatives, having been sort of way down the list, are now back up at the top. And there was an opinion poll, I think, yesterday or today, which shows them something like 12% ahead of the Labour Party. So Brexit is going to happen on October the 31st. I don't think the EU is going to negotiate. I think what will happen is that the negotiations will happen afterwards under GATT Article 24. And what happens with GATT Article 24 is that when you get a change in a treaty, that permits the participants in a treaty to continue to negotiate on the basis that the trade arrangements still exist until they're actually replaced by a firm treaty. But it has to have the agreement of the EU and the UK.
My goodness. So, a lot of fear mongering going on. And just to clarify then, in regards to the EU, is it because of the UK not being part of the European Union that these jobs are going to be lost within the European Union? Is that the connection that they're making? And why should that be a reason for people in the UK to care? I mean, I don't mean it's that the people in the UK are not sympathetic, but if the UK is a net contributor and they don't feel like there's not reciprocation, or there's not, it's not aligning with the interests of the country, then, why should that be a problem for the people in the country?
Kenneth, you're being entirely logical, but we're talking politics, unfortunately. I think, in answer to the question which was contained in that, I think that the estimates in the EU assume that there will be trade disruption between the EU and the UK. Now, this can happen on several levels. It can happen at the ports, which is not going to happen, incidentally. That's not going to be a problem. But the other thing is that we don't quite know how supply chains are likely to work out. I mean, for example, a French company will have component suppliers from the UK. How's that going to be affected? All these things. I don't actually think it's going to be much of a problem, because already these supply chains, they take in stuff from outside the EU anyway. But it's all this sort of concern. I personally have a greater concern on this, and that is, I look at the share price of Deutsche Bank, and I see that, last week it got down to €5.80, which, given something that was as high as 120 at one stage, and Commerzbank, that was up at €290 at one stage, and that again is about €6. So we have problems in the German banking sector. Now, Germany is by far the strongest component in the EU, and yet their banks are in difficulty. So I can see that this crisis, this global crisis, the trade crisis, if you like, probably one of the first dominoes to fall is going to be in the EU, and it's probably going to be in Germany. So, meanwhile, we're trying to get the hell out of there. This is going to cut up, I think, potentially quite rough. And not only that, but while we are in the EU, we are potentially on the hook for bank rescues elsewhere in Europe. Whereas if we're not in it, we're not potentially on the hook. But we will, in either event, have a problem, because if you get some sort of banking crisis in the EU, then we've got a banking sector in the more or less the world's largest international market in terms of forex dealing and all the rest of it. Counterparty risk in London is absolutely enormous. So, this is not something we want to see at all. But I just begin to worry that the timing of Brexit could actually coincide with increasing financial problems, or problems in the financial sector, systemic risk, and all the rest of it in the EU.
Alasdair, one thing that we really didn't touch on much on this interview, which I thought we'd be actually getting into more, but I'm happy to discuss all these other things because it's so interesting and so fascinating. But I got to get your thoughts on gold and silver and what we're seeing right now in 2019, especially since the end of May. I mean, quite the turnaround and quite the decisive turnaround. Even right now in US dollars, we've seen, metals just kind of fluctuate, and around the $1,500 range. And we've seen it hold that $1,500, which I think is really substantial. If you go back even for the last couple of years, gold would move up and then really kind of get people excited, and then, materially fall quite hard. We didn't see much action, in 2016 or the end of 2018 last year, when the gold was starting to move up and the miners were just still not in the belief phase. And arguably the miners right now are still questioning whether or not we are in a gold bull market. I mean, some of them are moving up, but I still think they're lagging what historically they do, because again, our most recent experience has been, hey, we move up and then we have these massive corrections. So having said that, I mean, what are your thoughts right now on the precious metal sector and where they're going from here?
Well, I think the way to look at it is not so much that gold and silver are rising, but money is falling. By money, I mean paper currencies. Because the reason behind this, I mean, you could take a technical view and say that gold bottomed out in December 2016. It had a run up, and then you had a consolidation, which basically was from about the middle of 2016. Sorry, it started in 2015. you had a 6-month run up, and then you had something like a 36-month sideways move before the breakout. So technically, that looks pretty good. But I think the important thing is that very few people own gold. I mean, an awful lot of people reckoned that gold had to get through 1350, 1360 before you could say that the bull market was being resumed. What that meant basically was everybody was sitting on the sidelines. So when it went through, it just roared through, and everybody was left holding no gold. It was an extraordinary situation. And the same was true in silver too. Now, since then, I think that the, if you like, the gradual evidence coming out that we do actually face a recession now, basically means that people are beginning to think, well, this means that you're going to get more quantitative easing, you're going to get deeper negative interest rates probably. Now, if this recession is at all deep, how deep can negative interest rates go? And then if you've got that, what do you hold? I mean, are you going to leave $1 million sitting in the bank with 3 or 4% being deducted from it per annum because there's a negative interest rate on it? You certainly won't be able to turn it into dollars because there will be ways and means in which they'll stop you doing that. So what do? I think you go out and you buy your gold, you buy your silver, you probably buy your Bitcoin too. And in fact, my friends in China tell me that if there is that sort of collapse in the purchasing power of money, then they're really going to go for Bitcoin. Which is an interesting one because there's a lot of people in China who could go for Bitcoin. So I think what we are seeing now is we are seeing the beginning of an understanding amongst people who have yet to own gold that there is going to be an acceleration of the production of money to stop a recession from getting over deep. And that is going to mean deeper negative interest rates in Europe, deeper negative interest rates in Japan, and also Sweden and Denmark, possibly negative interest rates in the US and the UK. And bear in mind, the central bank's models don't sort of reckon that the zero bound is if you like, an obstacle to this at all. No, I mean, they work on something called the Taylor rule. And that's just a question of okay, what are the prospects, and therefore what level of interest rates is appropriate. And if it's -3 or 4%, that is what the model will say, and that, despite the misgivings of central bankers, is probably what they'll end up doing. So I think that it's these dynamics that are beginning to become more likely, if you like, that's really driving the gold price. And in that context, I think silver has got a lot of catching up to do. So that's probably going to perform better. But the other thing I would say is that gold is not an investment. It is actually money. There are lots of gold-related investments like mines, ETFs, and so on and so forth. But if you really want to protect your money, the only way you can do it is by having physical gold, and having physical gold stored outside the banking system, beyond where the governments, if you like, in their desperation, can put their hands on it.
Alasdair, then tell us a little bit more about goldmoney.com. And obviously all the things that you guys provide there, the resources, and if people obviously want to own gold, what are some of the ways they can go about doing that?
Well, I think I've sort of almost given an advertisement for Gold Money. You just go on the site, goldmoney.com, and you can see you can open an account. Basically, what we do is we store gold, silver, platinum, and palladium in vaults, which are LBMA, that's London Bullion Market members around the world, and they are stored in the name of the client. They're not stored in the name of Gold Money. So consequently, it's your gold stored in a secure vault, fully insured, and all the rest of it. So that is basically Gold Money's mainstream business. We're also beginning to do things like facilitating the ability to borrow money against your gold and silver, which I think some people are likely to use for gearing up. Others use it for, you've got your investment, let us say, or your security with gold or silver, and meanwhile you can borrow fiat money against it to go and do whatever you want. So that's another aspect that we're doing. And lastly, the third thing, we've really taken a leaf out of what the Chinese and the Indians do. We've set up a company called Monet, which is associated with us. And Monet basically does 24-karat jewelry. And it's designed by a really nice lady who lives in San Francisco, who's Korean in origin, but was in the Parisian houses. And Diana Picasso, granddaughter of the great Pablo, is on the board, overseeing design and all the rest of it. What we do with that is we sell it at a 20% premium to the bullion price, but we guarantee a buyback 10% under the bullion price. So that's rather like the Indian ladies, if you like, looking after the family money in the form of bangles and all the rest of it. So those at the moment are our three sort of main areas of activity. But I think the principal one for those of us that are worried about the prospects for fiat currency is our ability to store your gold in a different jurisdiction from the one in which you live, in secure, insured vaults.
Alasdair, I want to ask you one last question, and I hate putting, and I've had a lot of people ask me this as well, the price predictions for gold, and I don't like that as to where you think it's going to go. So I ask it in a different way. How high would you be comfortable in this current environment? Obviously, things change. You need to assess your analysis as time goes on and we see things unfold. But how high would you be comfortable seeing gold go, given the current circumstances? I mean, for instance, if gold went to $2,000, would you be selling your gold because now you believe it's overbought? So, is that number 2,000? Would it be 3,000, 5,000, 10,000? How would you answer that question?
I actually use it as money, is the answer. So I don't look at it in terms of what level. I have gold. When I get fiat currency, I immediately change it into gold. And I've been doing that for about the last 4 or 5 years. And so I could take the sort of positive view and say that, I've been sort of accumulating gold and saving a bit, after spending from the low at 1,050. I could take the view that rising gold prices means that I'm earning less. But I'm not going to answer your question in terms of where I think gold is going to go. This is a question of where do the currencies go? How far do they collapse? And that is really why I hold my savings in gold. I hold it, if you like, as ready money. It's sound money at a time when unsound money, in my view, is falling apart. If I was buying or selling a gold mine or a silver mine, I would take a different view. And there it would be sort of, I'd look at the charts probably, and I would look at the fundamentals as well, and I would come to some sort of judgment. That is where I would do my investment work. As far as physical gold is concerned, it is money. It's pure and simple. It's sound money against rubbish money. And I'm quite happy staying with sound money and keeping everything possible out of rubbish money.
Love it. Love it. Well, Alasdair, thank you so much for coming on Crush the Street and sharing your deep wisdom on the markets with us. I appreciate your time, and hopefully we can do this in the very near future once again.
That's very much my pleasure, Kenneth.